Welcome back to the channel. I hope all of you are having a great day. So today's video is going to cover some really important things. We had the unemployment data come out yesterday, a little bit lower than last month. We have the FOMC meeting coming in a couple of weeks. We're going to talk about what the Fed's going to do with the interest rate in terms of how that's going to affect the markets. And then I have a chart to show you guys that's extremely important, allowing you to understand on how not to get stuck in this bull trap that might be coming up. But before we get started, I highly urge you guys to subscribe and like the video down below, as we're making daily content on this type of stuff. And trust me, you do not want to miss a single video. Let's get right into it. So if you're a regular viewer of this channel, you know we've been talking about the unemployment data for quite some time now, for a couple of weeks, and how it could affect the markets. Well, I'm not going to spend too much time on it because we've been talking about it so much in the past, but it came in at 3.5%, 0.2% lower than the previous month. Basically what this means is that it shows the Fed that them raising interest rates as of right now, is not having a direct correlation in terms of rising unemployment, which gives them the green light to continue to raise interest rates. So why is that important? Why do we care? And how does that even affect the markets? Well, I'm glad you asked. But basically what we're looking at here is that the orange line is unemployment and the blue line is interest rates. So before we go into the history of it all, I do want to urge you guys to understand that the Fed is looking to raise interest rates in between anywhere to 4 to 5% by around the spring of 2023, which could lead us to, let's say like right around this area right here. Again, they've never raised interest rates this fast. I mean, it's 475 basis point rate hikes, which is extremely fast. And they still have a ways to go, at least 1.25%. And most people are thinking they're going to raise it another 75 basis points in this next FOMC coming in about 2 weeks. But for the Fed, one of their big concerns is unemployment. As long as unemployment is low at these low levels, I mean, it's literally at 3.5%, which, is one of the lowest that it has ever been. It's showing the Fed that them raising these interest rates at this type of a precedent isn't really affecting unemployment. And so what they're going to do is continue to raise at the aggressiveness that they already have. But one important thing to notice is that whenever interest rates are raised, and this doesn't always happen, but typically it does, is that whenever you get an interest rate hike, this blue line, whenever you get the hike and it kind of tops out and they're done, then literally right after, unemployment starts to rise. What happens is they get this unemployment rate hike right around here, and then unemployment starts to rise. Interest rate hikes go up and then they stop right around here, and then what happens is unemployment rises. One more time, you get an interest rate hike, it tops out, and then unemployment rises. Obviously this is the COVID pandemic, so there's a little bit of a different factor coming in here as to why it was so aggressive. But basically what I'm saying is that as interest rates start to rise, and once they cap out and they're done, typically that is when unemployment lags behind, and that's when we start to see a top out. When unemployment gets very high to certain levels, that's when the Fed declares the recession. But by that time, the stock market and the markets have already priced in the bottom. But it does take some time. And just to show a couple examples, whenever the interest rates were done hiking right around here, I mean, we're looking at August of 2000, and then unemployment really topped out in June of 03. So basically 3 years. Then what we look at is, let's say they topped out right around here, November 06, unemployment topped out October 09, another 3 years. Interest rates topped out March 19th, and then unemployment rised at March 20, so 1 full year. What we can see is that by the springtime is right around here, April of 2023, we could possibly get unemployment rise to the early parts of 2024 or even later, honestly. So again, it is a lagging indicator, but it is also something to look into. But a good thing to remember is that we don't have to wait that long for the markets to rise, because by the time that unemployment does peak and reach its height, the stock market bottom is typically in. And since, risk on assets are all being grouped in together, by that time, whenever the Fed actually pivots or stops raising interest rates, that's when we could actually look for a possible real bull markets to start to commence. Now that we've got the unemployment data out of the way, the next thing we have to look for next week is October 13th, and it's two really big things. It's going to be the core inflation rate for year over year, which is what the Fed looks at. Now, a lot of people think that it's going to be 0.2% higher than last month, which is bad because it's going to continue to give the green light for the Fed to raise interest rates a little bit more. And then you've got inflation rate, which is what the people care about, and people are thinking it's going to be 0.2% under, which, over the public and the consensus isn't really much of a change, but it is going down compared to the consensus. So it'll be interesting to see how these come out, because again, remember, the only reason we're talking about the Fed and macroeconomics is because that has such a huge weight on the markets as of right now. And the biggest thing as to why the Fed is raising interest rates is because, again, high inflation. I mean, we haven't seen again in 40 years, 1981 highs right around here. So that is their number one concern, and they've said multiple times that they're okay with crashing the markets in order to get inflation down. And typically when inflation does pivot at, very high peaks, that typically doesn't have much of a false breakout. So it doesn't like to peak, come down, and then shoot up again historically, but you never know what could happen. And I just want to remind you guys of how we got here and where we still have to go. I mean, just in this year alone, the bear market has hit the stock market as it's down 25%. Bonds have had their worst year in history. Housing prices are falling in over a decade. The economy has had 2 straight negative quarters of real GDP. Nuclear war is on the table, and the Fed still has to rate hike at least 1.25%. So while yes, it has been some pain, we are definitely not out of the woods, and we could see much more to come. And this is one of my main concerns in terms of what the market could do. Currently, if you look at this sentiment cycle, it might be a little hard to see because of the blurriness, but basically we are right around here at discouragement. We've already had the main part of the bear market hit because the stock market and the markets are forward looking, so we've already kind of priced in a lot of what's been happening. But right here is where we are at. The problem is that we could get a bull trap where a lot of people think everything that is bad is behind us. There is hope in the markets start to go up, everyone starts to buy in, we get this bull trap, and essentially what happens is we get this fake push to the upside, which in actuality, when you zoom out, is just actually a lower high, and then the markets drop one final time, just a little bit lower than the last time. And that's when we get our final capitulation from people who bought in here, people who were excited because they were tired of the bear market. And again, things usually don't play out the way you want them to. So to expect a bullish rise in the markets right now could probably be the thing that nobody expects. And, people are very emotional in the markets. And so you could see a buying frenzy in the next couple of months, or at least Q4. And then you get your final push to the downside. And then we can maybe start that longer term uptrend. And the main reason I bring this up is because if you look at the data of the VIX, now the VIX is the volatility within the stock market. And so what I have here is the blue line is the VIX. And the orange line is the S&P 500, basically telling us what the stock market is doing. Then I have this yellow line at 40 points for the VIX. Any time that the VIX has gone above this 40-point line, we've seen major bottoms in the stock market, probably the lowest lows that we've seen. And what we've seen in history is that if we go all the way back in 2020, we had this pandemic low right around here. If we go all the way back here, we had the lows of 2011 right here. And then if we look right here, this is the Great Recession, which again were the stock market lows. If we go back here, this was the dot-com bubble, the lowest low that we had. Again, right here, this was another major push to the downside in the stock market. So as you can see, anytime that the VIX gets at the 40 point or above, that's when major lows are put in, and then the bull market starts to resume after that. What we've seen as of right now, that even though the stock market has been falling quite a bit, we still haven't even reached or been close to that 40-point volatility in the VIX. So while yes, we might get another pump to the upside, remember, if you look lower, that could just be a lower high forming. Even if we get all the way back up here, go up 20-30%. But remember, once the VIX gets up here, once volatility starts to kick in, maybe we can get capitulation, our final low right around here. And that could be around next year around springtime, in line with when the Fed stops raising interest rates. And so the final chart that I want to look at is when we're talking about this is that yes, unemployment data came out and you can see that the market started to fall a little bit on the daily chart for Bitcoin. So this could have been a false breakout. A lot of people were excited for it and then we're falling. And now what could happen is, again, as we start to see maybe a rally off of these lows, create another strong support level right around here, people start to get into a buying frenzy. Maybe we break this high right around here. People are starting to go crazy. We get into a bull trap. But again, if you zoom out and remember that we are just in a macro downtrend, anything above, or below 47,000 is just a lower high. So no matter what happens, people are going to get into the market, and then maybe we get that final capitulation, that final crash, and then we can see our lower lows be made, support being held, and then we got the bull market coming in early or middle parts of 2023, which is just my opinion. But that's everything I have for this video. I hope you guys got some knowledge out of it. I hope you got a little bit smarter today or found any value in it. And if you did, make sure to subscribe and like the video down below. And in the comments, let me know what you liked and didn't like about the video. Till the next one, I'll see you guys then. Peace.